Good evening. My name is Nancy, and I'll be presenting today along with Lonray, Chloe, and Amber. We are GreenFi, and we are excited to share with you our comprehensive proposal. Within our presentation, we will speak to why SCD Asset Management is a leader in the transition to incorporating ESG principles into the investment management process. Our proposal meets the criteria to achieve a total transition to net zero by 2032, while also obtaining the desired return. For our investment strategy, we diversified through capital allocation and adjusted asset weights to achieve the desired return and risk tolerance. Finally, a key component of our strategy is to monitor the actual emissions reductions using our expected path to net zero model. Our portfolio proposal has a nominal target return of 7.4%, volatility of 4.6%, and Sharpe ratio of 1.6. For our portfolio mix, we recommend allocating 60% to global equities, 25% to private credit, 10% to real estate, and 5% to bonds. Our first approach to sustainability is to address our scope 1 and 2 emissions. We will achieve green building certification for all our locations and source all our energy from renewable sources. In addition, we are investing in renewable energy infrastructure for our own buildings and actively engage our workforce through education and awareness programs. We will achieve a net zero portfolio by design and through active monitoring of our assets to ensure we stay aligned with our targets. In order to succeed, we must include participation in coalitions and partnerships with like-minded peers in our strategy. Our progress will be well documented in a transparent manner through our annual sustainability reports. As with all the assets we manage, we have set targets aligned with the Science Based Targets initiative and follow global reporting standards. There is a growing concern that the Paris Accord target of net zero by 2050 is not aggressive enough to limit global warming to below 2 degrees. Looking at our graph, of the companies that have made net zero commitments, less than 30% have commitments to reach net zero before 2050. With our 2032 net zero target, SCD Asset Management hopes to forge a pathway for others to follow. The net zero investment landscape is new territory for all of us. Some current challenges we face in designing and maintaining a net zero portfolio include a lack of standardization for disclosure. A cost of working in this space is the added research and financial modeling required to verify that the products that we selected truly reflect our values and continue to be aligned through time. New policies, regulations, and incentives will play a big role in advancing the agenda, the lack of which will have a direct impact on our ability to reach our targets. At this stage in the game, claiming net zero is simply not enough. All parties need to act to reduce actual emissions to make it through this challenge together. Though the challenges we face are many, SCD Asset Management is here with solutions. Chloe will next take us through our investment framework, which will address some of these challenges.
Our sustainable investment framework guides everything we do. These are the 4 pillars of our sustainable investment framework. Purposeful integration. Sustainability is at the core of our investment philosophy. This does not mean that we are opposed to investing in high-emitting sectors. This means that climate factors permeate every step of our investment process, from initial screening to selection, and continues with the second pillar of our investment framework, active engagement. We will make every effort to further the climate agenda by being an active investor and corporate citizen, meaning that we will engage in dialogue with our portfolio companies to drive change at its roots and contribute to wider efforts in influencing change at the state level. The third pillar of our investment framework is continuous measurement. This means that we will seek to measure emissions based on reporting that adheres to global standards. Finally, the fourth pillar of our investment framework is agile adaptability. This means we will always seek to apply best practices and lead by example. We will also encourage our portfolio companies to do the same. With the 4 pillars of our sustainable investment framework to guide us, we considered a blend of quantitative and qualitative factors in selecting our securities and third-party asset managers. First and foremost, all securities must meet 2 criteria. Companies must have net zero or carbon neutral targets up to 2032, and those targets must address scopes 1 and 2 emissions, which means that companies must have a plan to reduce scopes 1 and 2 emissions as much as possible. And where it is not possible to reduce emissions, use offsets to essentially bring scopes 1, 2, and 3 net emissions to 0. Asset class specific criteria was layered on to select securities in each asset class. For equities, which constitute the majority of our portfolio, we considered qualitative factors such as management commitment to the cause and the quality of reporting and disclosures. We looked at whether management remuneration schemes are tied to net zero targets, whether reporting is comprehensive, among other dimensions. Additionally, we considered a blend of current and forward-looking quantitative factors such as the current level of emissions, trends in emissions output, implied temperature rise, and ESG risk ratings from third-party providers. For fixed income, we opt to track an index of bond securities because fixed income is the smallest portion of our portfolio, and so the criteria for selection was much simpler. The bonds need to be climate certified. This means that proceeds from issuance must be marked for climate change initiatives. For private credit and real estate, which make up the rest of the portfolio, they will be managed by two third-party asset managers that have been selected based on preliminary criteria, such as reputation, affiliations, commitment, and experience in the private credit and real estate space. Notably, asset managers must be signatories of the Net Zero Asset Managers Initiative and UNPRI, and managers need to have a well-laid-out plan to fully integrate ESG into at least 90% of assets under management by 2025. Above all, asset managers need to align with our sustainable investment framework. They need to demonstrate engagement and adaptability in their ESG efforts to date. Advanced stage screening would entail further due diligence with respect to those asset managers. Now, Lonray will take us through our investment portfolio.
We are recommending a strategic asset mix with 60% invested in ESG-focused global equities, 25% in private credit, 10% in real estate, and 5% in green bonds, with an expected return of 7.4% and a 95% probability of protecting capital. We arrived at this mix by considering the key requirements for CU's portfolio, protecting capital with moderate growth and a low risk tolerance. The asset mix is fully aligned with achieving net zero by 2032. We believe these asset classes give us the best opportunity to achieve net zero because they combine the principles of active and passive management in the right proportions. To arrive at this allocation and expected return, we performed historical analysis to estimate returns, standard deviations, and correlations of each asset class. We then adjusted the data to factor in forward-looking expectations. Based on this data set, we performed portfolio optimization and selected asset mixes that provides the best risk-adjusted return and highest probability of protecting capital. We performed this analysis for the existing portfolio as well. In the bottom left corner of your screen, you will see that our recommended portfolio performs better from an absolute return, Sharpe ratio, and probability of protecting capital standpoints. We believe our net zero focused asset mix provides sufficient return and capital protection to fund the endowment's obligations for the long term. To achieve net zero substantively by 2025, we tilted our equity portfolio strongly towards securities that have set a net zero target on or before 2025. By allocating 83% of our equity portfolio in assets that achieve net zero by 2025, we are able to make 50% of our portfolio net zero compliant. The rest of our equity portfolio is comprised of companies aiming for net zero by 2032. We feel confident about our selection and tilt because these companies we selected have strong fundamentals, and we believe ultimately that management that take the impact of climate change seriously will be better stewards of capital in the long run. Looking at our portfolio versus the benchmark, which is the MSCI ACWI Universal Index, we believe our portfolio is representative of the benchmark from both a country and sector perspective. To reach total transition by 2032, we will take an active approach in our allocation to alternatives like real estate and private credit by investing only in assets with stated goal of reaching net zero by 2032. To do this, we are hiring third-party managers like Franklin Templeton for real estate and Invesco for private credit. These asset managers have a proven track record of excellent ESG stewardship and superior performance in these asset classes. We will give them the mandate to invest in assets that seek to meet net zero target by 2032. We think this is important because this gives us the opportunity to directly impact decisions in our portfolio companies. For real estate, the fund will seek to invest up to 10% of our portfolio in direct property and real estate debt financing assets that have committed to a net zero target of no longer than 2032. We'll deploy our 25% allocation in private credit by seeking to invest in senior debt of mid-market companies in Canada, US, and Europe, with EBITDA of 10 million to 100 million and net zero target written into the debt covenants. Finally, Our 5% allocation in green bonds will be managed passively by investing in the Horizons S&P 500 Green Bonds ETF. This ETF only invests in bonds that are certified green by the Climate Bond Initiative. For a bond to be certified by CBI, it must invest 100% of its net proceeds to finance green projects, and it must be aligned with the Climate Bond taxonomy. I will now pass it on to Chloe to discuss how we manage portfolio.
Our investment portfolio is subject to market fluctuations that may bring the asset class allocations out of line with the optimal allocations. Hence, monitoring and rebalancing are crucial elements of our portfolio management process. We will, on a quarterly basis, review the asset class mix against the established minimum and maximum bounds and determine if rebalancing is warranted. We will also track and assess the financial and non-financial performance of the portfolio. To assess financial performance, we will evaluate on a quarterly basis the returns generated by our in-house managed investments, as well as the third-party managed investments against established benchmarks and our return targets for each asset class, as well as the return target for our overall portfolio. Meanwhile, the non-financial aspect of performance, which is arguably as important, if not more important than the financial aspect, is concerned with whether our portfolio companies are on track to meet net zero targets within the stated timelines, or what we refer to as the net zero pathway. We will measure progress along the net zero pathway on an annual basis, and the approach we will use will be discussed next by Amber.
Here is an elaborate description of our methodology to measure annual CO2 emissions. At portfolio level, we calculate a benchmark ratio of CO2 emission by revenue for the shortlisted firms with a net zero target of 2032. Then we choose and invest in best of these shortlisted firms by using our advanced screening criteria and calculate present-day CO2 emission by revenue ratio for our portfolio. If the portfolio emission by revenue ratio is less than the benchmark, then our portfolio is on track to become net zero by 2032. If it's greater, however, then we engage with the companies which are off target. At the company level, we'll use Apple as a case study to demonstrate how we measure annual emissions. We plot Apple's forward-looking projection of emission against time to reach targeted net zero. We also plot present-day emission data and any interim targets set forth by Apple to become net zero by 2032. As a result, we obtain an expected net emission region. We keep track of actual emission data from Apple annually and plot an actual emission curve using that data. If the actual emission curve is above the expected net emission region, then we actively engage with Apple to understand their response for being off target. Our active engagement approach starts at company level, which entails conducting continuous research using external information provided by Sustainalytics, MSCI ESG, and company disclosures, submitting our questions related to sustainability risk to the companies for written reply, conducting further investigation based on company's response, requesting additional information, and meeting with the management, tracking each engagement and monitoring company responsiveness. At broader level, our engagement activities involve lobbying for government taxation of high impact industries, forming coalition with other investment management firms, advocating for regulatory mandates on emission disclosure, and educating wider public to promote net zero investing. Here we take a look at some of anticipated risks in our portfolio and propose mitigants to minimize those. For example, under financial risk, we may encounter currency risk because our portfolio is heavily exposed to foreign currency. This can be minimized by entering into forward currency agreements. Similarly, for example, under non-financial risk, we may be exposed to greenwashing risk, as a lot of companies are claiming to be ESG focused but are not meeting the requirements. This can be mitigated by following science-based targets, GHG protocols, and frequent engagement with management. That's all from GreenFi team. We thank you for the opportunity to work on such a relevant and interesting topic. We certainly enjoyed working on this case and hope you will enjoy our presentations too.